This is Matthew Kratter from Trader University, and today I want to answer the question, did the bear market just end? Did the bear market in stocks and Bitcoin and crypto just end? And the way I'm going to approach this is by asking, did the Fed just make their pivot? So what happened yesterday is we had the Fed meeting. The Fed raised Fed funds, which is the overnight lending rate for banks. They raised it by 75 basis points by 0.75%. And we had this huge one-day rally in stocks and in Bitcoin. So the question then becomes, does the market understand that the Fed is done hiking rates for this cycle? Because if that is true, and if the Fed is done with their hiking, then it's definitely party time ahead. So we're going to be looking at some of the comments that the Fed made in Powell's prepared remarks before the press conference. And the word that I want you to focus on that you'll see that keeps jumping out is data dependent. So in his press remarks, Powell said, these are all quotes from Powell, over coming months, we will be looking for compelling evidence that inflation is moving down, consistent with inflation returning to 2%. We anticipate that ongoing increases in the target range for the Fed funds rate will be appropriate. The pace of these increases will continue to depend on the incoming data and the evolving outlook for the economy. So again, there's the sense of data dependency. Today's increase in the target range is the second 75 basis point increase in as many meetings. While another unusually large increase could be appropriate at our next meeting, that is a decision that will depend on the data we get between now and then. We'll continue to make our decisions meeting by meeting. You get the general idea here. This was the line that I think really made markets take off, though. As the stance of monetary policy tightens further, it will likely become appropriate to slow the pace of increases while we assess how our cumulative policy adjustments are affecting the economy and inflation. If you want to see where I got these remarks from, I will link to the transcript here of his opening statement at the press conference. Now, one thing I want to draw your attention to that is really quite strange and also quite economically illiterate is the emphasis that Powell made on how he's watching the job market. We see this in the FOMC official statement that job gains have been robust in recent months and the unemployment rate has remained low. We also saw it in Powell's answers to reporters, and I will link to it right here so you can listen to the actual words. But what he basically said, he said he does not believe that the U.S. is currently in a recession, and he pointed to the labor market as a source of strength. He talked about how many people were hired in the first half of the year, 2.7 million people hired. It doesn't make sense that the economy would be in recession in this kind of environment of strong job growth. Now, this is an appalling thing for a Fed chairman to say. This is economically and financially illiterate. I would refer Mr. Powell to Investopedia, and we can look here and see that some examples of lagging economic indicators include the unemployment rate. The unemployment rate, job growth, non-farm payroll growth, these are all lagging indicators. And I think there was a really good tweet that Jim Bianco put out showing monthly payroll changes, in other words, job growth, and he overlaid it with various recession bands, which are these gray bars here. And he showed that at the beginning of many recessions, you still had positive payroll growth. And this is widely accepted among economists that jobs and non-farm payrolls are a lagging indicator. They're not a forward indicator. And it would appear that Powell believes that they actually are. Either he's pretending he believes it, or he actually believes that you can look at the job market, see that it's strong, at least look in the rearview mirror, see that the job market is strong, and say that the economy is not in recession. And he said in very clear terms, and I'll link to it so you can listen to it here. It's at 1 hour, 20 minutes, and 44 seconds. He says he believes that the economy is not currently in a recession. This is clearly wrong, and it's hard to believe that he believes it. We learned this morning that second quarter GDP growth came in negative. So when you have two quarterly declines in GDP, the markets were expecting actually positive growth for the second quarter, but it actually was a decline instead. And when you have two straight quarterly declines, this is a very clear sign that the economy is in a recession. It's up to NIBER to decide officially whether this is true, but it seems clear to me that the economy is currently in recession. So here's how I'm thinking about this. Powell is saying repeatedly that he's not doing forward guidance anymore and that the Fed will be data dependent going forward. It's going to be dependent on what the economic numbers are between now and the September Fed meeting. Powell says the economy is not currently in recession. Powell is looking at the job market to make this call, which is a lagging indicator. The economy is clearly in a recession, I believe. Economic data over the next 8 weeks between now and the next Fed meeting is going to clearly show that's the case. And so I think we're going to be in a situation where Powell is going to be unable to deny that the U.S. is in a recession as we get closer to the September meeting. And this may begin to finally trickle through in the jobs reports. If we have a couple bad non-farm payroll reports, it'd be very difficult to then say that the U.S. economy is not in a recession. So the assumption I'm making here in this call, and you can question it and you can change the conclusion based on this assumption, whether you agree with it or not. My assumption here is that Powell will not have the guts to hike interest rates into a recession while we're in a recession 2 months before midterm elections. Even if inflation remains stubbornly high, I think inflation will actually tick down from here that we've seen the heights, at least in CPI inflation. And so this will help his case as well. We're not going to get anywhere close to 2% inflation, even in a recession. But what he'll be able to say is, look, inflation's come down, CPI inflation has come down, this fake measurement of inflation. Nevertheless, it's come down from about 9%, maybe it's dipped to 8 or 7 or 6%. This combined with all the recessionary signs will mean that he is done hiking interest rates. So I think we get one more, if even this, we get one more hike of 75 basis points in September, and then we're totally done. The worst is over, I believe, for stocks and Bitcoin. I believe now that we've seen the bottom in Bitcoin. So if we look at what the market is pricing in, if we look at Fed funds and the probabilities for the September 21st meeting, we can see that there's a 74% chance that they hike actually 50 basis points, and then there's a 26% chance that they hike 75 basis points. The current Fed funds is between 2.25% and 2.5%. So this is suggesting that Fed funds is going to peak somewhere between here and 2.75 and 3%. And this makes a lot of sense if you look at where the 2-year note is now. What I've said is a common rule of thumb is when Fed funds gets in the range, it gets slightly above the 2-year Treasury, you can tell that the Fed is basically done. So the yield on the 2-year U.S. Treasury is at 2.88% as of this morning. One more 50 basis point hike would get us to a range of 2.75 to 3%, which would be basically right where the 2%, where the 2-year government Treasury is, where the 2-year Treasury note yield is. So this all suggests that the Fed is done for this cycle. We can see that the 2-year note yields fell quite a bit yesterday after the Fed meeting, and they're well off the highs, which were close to 3.5%. We're now trading about 2.89%. And again, this is right in that range of where we'd be after another 50 basis points hike. We can see that the 10-year note has come down even more. So we've had the curve really inverting even more. And then if we look at risk assets and what they're pricing, Bitcoin is now above its 200-week moving average. I think Bitcoin is a fairly good leading indicator. And so I think a bottom has been put in. This 200-week moving average has been a very good place to buy Bitcoin. And I think Bitcoin is picking up on this. Stocks, even though they rallied yesterday, they're still kind of chopping around in this range. So I do now believe that the bottom is in for stocks and Bitcoin. Things could still be a little bit choppy, but I think the worst is over for this cycle. And again, the key assumption I'm making here is that even if inflation is at 6 or 7%, Powell is not going to have the guts to get even more hawkish going into the midterm elections. So all of this leads me to believe that the bear market is indeed over. The bottom is in for Bitcoin. The bottom is in for stocks. The Fed has just pivoted. Now, again, it's very, very risky to make calls like this. I continue to dollar cost average Bitcoin no matter what. But I think reading the Fed tea leaves, we can conclude that the worst is over. The bottom is in. And at the most, we have one more Fed hike of 50 basis points. Then we're basically done for the cycle. Obviously, there are a lot of geopolitical things that could happen. Bad things could happen with China and Taiwan. Bad things could continue to happen with Russia and the Ukraine, and these could lead to the sell-off of risk assets. But I think the Fed has basically gotten to where it needs to be. It's already blown up so many things, and once the economy clearly moves into recession, as I think will become apparent in the coming weeks, Powell will not have the political capital or the support of politicians to tighten further from here. So I think the bear market is in fact over. If you found this video helpful, be sure to hit that subscribe and like button. Hit the notification bell if you want to be notified when I publish my next video. And let me know your questions and comments in the comment section below. Thanks a lot for watching, and I'll see you in the next video.